Okay, so today I want to talk about something that honestly keeps me up at night. Like when I think about how many people are making this mistake right now, like without even knowing it. And I want to be very direct about this from the beginning. I am not here to tell you that gold and silver are bad investments. I own gold. I own silver. I think precious metals belong in a serious long-term portfolio. What I am here to tell you is that there is a specific, concrete, dangerous mistake that a very large number of gold and silver investors are making right now, and most of them have no idea they are making it. And here is the thing. The mistake is not in how much they own. It is not in which metal they chose. It is in the form they own it in. And that distinction, could mean the difference between protecting your wealth in a crisis and finding out that the protection you thought you had, was not actually there when you needed it most. So let me ask you a question, and I want you to really think about this before you answer it. If you own gold or silver right now, and a genuine financial crisis hit tomorrow, and you needed to actually take possession of what you own, could you do it? Like physically, actually, in your hands or in a storage vault you have direct legal title to. Could you do it? For a lot of people watching this, the honest answer is no. And the reason why is what I want to spend this entire video explaining. So let me start here. Gold hit an all-time high of $5,589 per ounce in January 2026. Think about that number, $5,589 per ounce. And according to the World Gold Council, global gold-backed ETF holdings reached an all-time high of 4,171 tons by February 2026. Total assets under management in gold-backed ETFs hit a record $701 billion. $701 billion. So there is more money in gold-backed investment vehicles right now than at any point in history. More people think they own gold than at any point in history. And here is the problem with that. A very significant portion of those people do not own gold in the way they think they own it. They own a financial instrument that tracks the price of gold. And in normal times, those two things look identical. The price goes up, your account goes up. The price goes down, your account goes down. You look at your brokerage and you see gold. It feels the same, but they are not the same. And in a crisis, the difference between those two things is not academic. It is everything. But before I get into the mechanics of how this works, I want to share something with you because I think it sets the context for why this matters so much right now specifically, not just in theory. Gold pulled back roughly 16% from its January 2026 all-time high of $5,589. So gold had this enormous run-up, hit a record that nobody had ever seen before, and then gave back a meaningful chunk of those gains in a relatively short period. And I want to ask you a question about that. When that correction happened, what happened to the investors who owned physical gold in their possession or in allocated vaults compared to the investors who owned gold through paper products? The answer is that both groups saw their holdings decline in value in dollar terms. The price went down, and so the value went down regardless of what form you owned it in. So far, the experience was the same, but here's where it started to diverge. The gold and silver ETFs that were leveraged fell significantly more than the underlying spot price. Silver in particular, as I will explain in more detail later, fell about 30% in a single day in late January, while physical silver premiums at dealers stayed elevated. The ETF price crashed. The cost of acquiring or the premium on selling physical metal did not crash by the same amount. That gap, that divergence between the paper market and the physical market is the thing I want you to understand, because that divergence is what happens in stress. And in a genuine crisis, that divergence can become a chasm rather than a gap. Okay, so let me explain this clearly, because I think this is where most people get lost. There are basically three ways to own gold and silver: physical possession, allocated storage, and unallocated paper exposure. And I want to walk through each one because understanding the difference is the entire point of this video. Physical possession is exactly what it sounds like. You buy coins or bars, you take delivery, and you store them yourself at your home, in a safe, in a personal safe deposit box that you control. When you own gold this way, no one else is involved. There is no counterparty, there is no intermediary, there is no fund structure, there is no dependence on anyone else's solvency or honesty or operational integrity. If the financial system has a problem, your gold does not have a problem because your gold is not inside the financial system. It is in your hands or under your control. That is the purest form of ownership, and it is the form that has preserved wealth through every historical crisis that I have talked about on this channel. Allocated storage is the second tier. You buy physical metal, but instead of storing it yourself, you store it in a third-party vault. The critical word here is allocated. Allocated means that specific bars with specific serial numbers are assigned to your account. They are yours. You have direct legal title to them. If the vault company went bankrupt tomorrow, those specific bars are your property. They do not become part of the bankruptcy estate. They are not pooled with other investors' metal. They have your name on them, essentially. This is a legitimate and relatively safe form of ownership, particularly for investors who have large enough positions that storing metal at home becomes impractical or a security concern. Most major gold ETFs like SPDR Gold Shares and iShares Gold Trust use allocated storage for the metal they hold. Now, before I get to the third category, I want to pause on allocated storage for just a moment because there is a nuance here that matters. Not all allocated storage is created equal. The key thing to look for when you are using a third-party vault is whether you have the right to take physical delivery of your specific bars at any time. Some vault providers advertise allocated storage but have complex or expensive delivery processes that could take weeks. Some have restrictions on delivery that make the allocated label somewhat misleading in practice. And some have insurance arrangements that may not cover the full value of your holdings in a severe scenario. So when you use allocated storage, the questions to ask are, can I request delivery at any time? What is the process and timeline? Is my metal fully insured at replacement value? And is the vault audited by an independent third party on a regular basis? Those are not paranoid questions. They are the responsible questions anyone using precious metals as a crisis hedge should ask. Make sure the process actually supports the reality of ownership. Now here is the third category, and this is where the blind spot lives. Unallocated paper exposure. This includes a lot of things. It includes ETFs that are not fully allocated. It includes gold futures contracts. It includes gold certificates from banks. It includes digital gold products where you own a fractional claim on a pool of metal. It includes the gold accounts at some online platforms where your ownership is a ledger entry rather than a title to specific metal. And it includes what the industry calls unallocated accounts in the London OTC market, where a bank essentially owes you gold but holds it in a pooled account where the specific metal is not identified as yours. When you own gold through an unallocated structure, you are not a gold owner in the way most people think. You are a creditor. The entity holding your gold owes you gold. That is different from you owning gold, because creditors stand in line when a company has a problem. And in a genuine systemic crisis, that line can get very long, very fast. And I want to give you a real example of this because I think theory without evidence is not convincing enough. In January 2026, after gold hit its all-time high above $5,500 and silver had doubled over the prior year and risen another 50% just in January, both metals crashed. Silver fell about 30% in a single day. Gold fell sharply as well. And here is the interesting part. Gold ETFs and silver ETFs fell more than the physical market prices in many cases. The Bank for International Settlements analyzed this and found that retail-driven exuberance channeled through ETFs, combined with daily rebalancing of leveraged ETF products and margin-triggered liquidations, amplified the swings dramatically. The ETF product moved more violently than the underlying metal because the ETF is not the metal. The ETF is a financial instrument that is supposed to track the metal. And financial instruments, when stressed, can behave differently from the underlying asset they are supposed to represent. Now imagine that scenario not during a routine market correction, but during an actual systemic financial crisis, a banking crisis, a currency crisis, a scenario where counterparties start defaulting. What do you think happens to unallocated gold claims at a bank that is in trouble? What do you think happens to ETF redemptions when everyone wants out at the same time? I am not saying these outcomes are certain or inevitable. I am saying that the risk exists in a way that most gold investors have never been told about clearly and directly. Okay, so let me talk about something specific that I think is really important and that most people in the precious metal space either do not know about or do not explain clearly enough. And that is the concept of paper gold versus physical gold and what happens in a genuine supply squeeze. The COMEX is the main exchange in the United States where gold and silver futures are traded. Most contracts on the COMEX are never intended to result in physical delivery. They are settled in cash. The paper market for gold and silver is enormous relative to the physical market. Some estimates put the ratio of paper gold claims to actual physical gold at something like 100 to 1. That means for every ounce of physical gold that exists in deliverable form, there are potentially around 100 claims on that ounce through paper contracts of various kinds. In normal times, this is fine. Not everyone takes delivery. The paper market is a price discovery mechanism and a hedging tool, and most participants are not trying to walk out the door with actual metal. But here's the scenario that some serious analysts like Kyle Bass have warned about for years. What happens if a meaningful percentage of paper gold holders decide they want physical delivery at the same time? The COMEX does not have 100 ounces of physical gold for every paper claim. If delivery demand spikes significantly, the exchange either has to find metal from somewhere, pay a premium to source it, or settle in cash at a discount. And a cash settlement when you wanted physical metal is not the same thing as getting what you thought you owned. In a genuine crisis where the value of paper assets is what is being questioned, being paid in paper for a claim you thought represented physical metal is exactly the wrong outcome. Now, I want to be clear again. I am not saying the COMEX is about to default. I am saying that the paper gold system creates a structural vulnerability that is not present when you hold physical metal directly. And that vulnerability becomes most relevant exactly when you need it to be least relevant, which is during a financial crisis. Now, I want to take a step back for a moment and address something that I know some of you are thinking right now. You might be thinking, okay, but GLD and IAU are the biggest gold ETFs, and they are allocated. So what is the problem? And that is a fair question. Let me give you a direct answer. The problem is not that the major physically backed ETFs are fraudulent or that they do not hold gold. Most of them do. The problem is the access question. When you own shares in GLD, you own shares in a trust that holds gold. That trust holds allocated gold. The gold is real. But can you as an individual investor pick up the phone tomorrow and say, I want to take delivery of my proportional share of that gold? No, you cannot. Physical redemption from GLD is only available to authorized participants, which are large financial institutions. Individual investors exit their GLD position by selling their shares back into the market. In normal market conditions, that works fine. You sell your shares, you get dollars, you are done. But in a scenario where the financial system is under stress, where brokerages are having problems, where settlement is disrupted, where you specifically want metal rather than dollars, that exit mechanism is exactly what you cannot use. You cannot convert your GLD shares now to physical metal. You can only convert them to dollars through the market. And if the reason you owned gold in the first place was to have something that is not dollars and not dependent on the financial system, then in that specific scenario, you are stuck with something that only converts back to the thing you were trying to protect against. That is the blind spot. Not that ETFs are fake, not that the gold is not there, but that the exit path in a crisis is not the exit path you need. So let me now talk about silver specifically because silver has some additional dynamics that make this blind spot even more important. Silver fell 30% in a single day in late January 2026. That was in large part because the ETF and paper market dynamics amplified the move. Leveraged silver ETFs saw some of the largest single-day declines. But here is what was happening in the physical silver market at exactly the same time. Premiums on physical silver coins and bars stayed elevated. Dealers were still charging above the paper spot price for physical metal because the physical market and the paper market were not moving in lockstep. The paper price crashed. The cost of actually getting physical silver did not crash by nearly the same amount. That spread between the paper price and the physical delivery price is called the premium. And that spread tells you something really important. It tells you that the paper market and the physical market are not perfectly connected. And in stress scenarios, they can diverge significantly. What does this mean for you practically? It means that if you own a silver ETF or a paper silver product and silver price drops 30%, your account is down 30%. But if you own physical silver and want to sell it, you might find that dealers are paying you more than the paper spot price because physical supply is tight. Those are two very different outcomes from what looks like the same investment. One is a claim on a financial instrument. One is actual metal in your hands. Now, I want to bring up something that a lot of people in the gold and silver community do not talk about enough. And that is the difference between what happens when you try to sell paper gold versus physical gold in a crisis scenario. When you want to sell paper gold, you put in a sell order through your brokerage account and it executes at the current market price. Simple, fast, electronic. That convenience is real, and it is one of the genuine advantages of paper products. Liquidity is excellent in normal conditions. But here is the scenario that the paper market is not designed for. What if you do not want to sell? What if you want to convert? What if gold is at $8,000 an ounce in 3 years because the dollar has weakened significantly and you do not want dollars? You want the gold. You want to use the gold to buy land, to pay for property in a hard asset transaction, to store value outside of the fiat system entirely. Paper gold cannot do that. Physical gold can. And what if you want to pass wealth to your children or grandchildren outside of the financial system? Physical gold in an allocated vault or in your possession transfers differently than a brokerage account position. It is tangible. It is private. It does not depend on an institution being solvent or accessible or cooperative. These are not mainstream scenarios for most investors today, but they are exactly the scenarios that gold has historically served in human civilization. And when people say they are buying gold as a hedge against systemic risk, the version of gold that actually serves that purpose is not the ETF. It is the metal. I also want to address the common argument that physical gold is inconvenient, that you have to worry about storage and insurance and security. Those concerns are real. I am not dismissing them. But here is how I think about that trade-off. The inconvenience of physical ownership is a fixed, predictable cost that you can manage and plan for. The risk of paper ownership in a systemic crisis is variable and potentially much larger than the inconvenience you are trying to avoid. Insurance for physical gold is available and not prohibitively expensive. Secure home storage options like quality gun safes have become widely accessible. Allocated vault services from reputable providers are available at reasonable annual fees. The infrastructure exists. The question is whether you engage with it. And here is something else worth knowing. The sophisticated investors are increasingly aware of this. The Bank for International Settlements noted that there has been a divergence between outflows from some large unallocated ETF structures and inflows into more explicitly physical vehicles, meaning the people who understand these markets deeply are moving money out of paper claims and into allocated physical positions. They are not moving away from gold and silver. They are moving toward a better form of ownership within precious metals. So let me now give you the practical framework for thinking about this, because I do not want to just tell you what the problem is. I want to give you something actually useful. The first thing I would ask you to do is look at exactly how you own your gold and silver right now, not just what amount you own, how you own it. If it isn't an ETF, research whether that specific ETF uses fully allocated storage and whether you as an individual investor have the right to request physical delivery and what the process for that is. GLD and IAU, the two biggest US gold ETFs, use allocated storage. But the right to physical redemption is generally only available to authorized participants, which are large financial institutions. Individual investors cannot easily redeem for physical metal. That means your exit in a crisis is through selling back into the market, not through taking delivery. If it is in a brokerage account as a futures position or a certificate or a digital gold product, understand exactly what you own. Is it allocated? Is it unallocated? Is it insured? Is there a bail-in risk if the institution holding it has financial difficulties? The second thing is to think about what role gold and silver are playing in your portfolio. If your purpose is short-term price speculation, paper exposure is probably fine. You want liquidity and you are not concerned about systemic risk scenarios. But if your purpose is wealth preservation through a genuine crisis, which is the reason most people buy gold and silver in the first place, then the form of ownership matters enormously. Physical metal held directly or in a fully allocated vault that you can take delivery from is a fundamentally different thing from a paper claim. The third thing is to think about proportion. Most serious precious metals, investors do not recommend putting everything into physical possession. There are real costs and real logistical challenges to storing physical metal securely. What the more sophisticated approach looks like is a tiered structure. Some physical metal that you hold directly for the worst case scenario. Some allocated storage for larger positions that you have verified you can take delivery from. And perhaps some ETF exposure for the portion of your holding that is primarily for price exposure rather than crisis insurance. And the fourth thing is to actually do something about this if you discover that you have a blind spot here. Because knowing the problem and not addressing it is the same as not knowing. If you realize all your precious metals exposure is through paper vehicles, you cannot easily convert in a stress scenario that is a gap worth closing deliberately over time. Here's the thing that I keep coming back to. People buy gold and silver because they are worried about the financial system. They are worried about inflation, about currency debasement, about systemic risk. Those are exactly the right reasons to own precious metals. But if you own them in a form that depends on the financial system working correctly, you have partially negated the reason you bought them in the first place. Physical metal that you actually own and can access is the version of gold and silver that has preserved wealth through every systemic shock in history. A paper claim on gold is a different thing. It is better than no gold exposure, but it is not the same thing. And understanding that difference before the next crisis is exactly the kind of preparation that makes the difference between being protected and just thinking you are protected. One last thing before I wrap up. I want to address the question of how much of your gold and silver exposure should be physical versus paper. And I am going to give you my honest thinking on this rather than a generic answer. If you are in the early stages of building a precious metals position and you are primarily interested in price exposure right now, a reputable ETF is a reasonable starting point. But as that position grows in size, and as your financial situation becomes more mature, and as the purpose of the holding shifts more toward wealth preservation and crisis protection, the proportion in physical or allocated form should grow. A position where all your precious metals exposure is in paper products and none is in a form you can physically access is not delivering the full value of what precious metals are supposed to provide. If this kind of breakdown is useful to you, subscribe to this channel, because this is what I do here. I take the things that most financial coverage glosses over and I explain them in plain English, directly, with the data behind them. Not what sounds good, what you need to know to make better decisions with your money. See you at the very next one. Take care.